All right, well, the mood of the markets as we start a new trading week seems pretty positive. We've got the S&P 500 building on the gains from Friday of last week. We're up close to 0.5%. The TSX, which has been on a roll, it's actually now up in 12 of the past 14 sessions. Let's get some perspective on the market mood. Adam Johnson joining us, founder and author at the Bullseye Brief. AJ, nice to see you. So I guess I will start with where we're at, and it feels like the conversation around interest rate cuts being back on the table and some pretty good earnings so far during earnings season have given investors some fresh desire to buy into stocks that had lost some momentum. What's your take?
Yeah, I like that. I think there are two things going on, John. First of all, I think we are all so sick and tired of the great rate debate, right? When will the Fed lower rates, and if so, by how much? But point number two is what I think ultimately really matters, and that's no matter what the Fed does, we have very strong earnings, John. And at the end of the day, earnings is, I think, the single most important factor driving stocks. Yes, I know interest rates have been the story for the past 18 months, but now that we have accelerating earnings, call it somewhere between 5 and 8%, with, by the way, an average surprise rate this earnings reporting season of about 9%. That's very strong. It gets you to $250 of earnings for the S&P 500, I think, over the next 4 quarters, and that may go as high as 280 as you go out to next year. So yes, the Fed at some point is going to lower rates. I think it's probably one in November, one in December. Okay, fine. But I think, again, the more important story is earnings growth. Corporate America is making a lot of money.
I thought it was interesting. I was looking at in the Canadian stock market in this recent rally, which is basically 2 weeks strong now, which sector it had the best performance, and it was the utilities. So there did seem to be an immediate response to hard-hit interest rate sensitive stocks as that narrative started to change again.
Yeah, and I think there's something else going on here, John. Utilities and real estate investment trusts, or REITs, kind of trade like bonds, and they tend to do well when inflation is coming down. You could make 2 comments about inflation coming down, or at least the market anticipating that inflation is coming down. Number one, it really is. CPI was over 9%. It's now 3.5%. But I think there's something else, and that is that I think, John, the market is starting to price in a Trump victory. And you say, well, why does inflation have anything to do with the Trump victory? Because a Trump administration is probably less inflationary, less inclined to spend money than a Biden administration. You look at the CHIPS Act, you look at student loan forgiveness, you look at infrastructure spending. All the thing that the Biden administration has done is actually inflationary because it's about the government spending money. I would add to that spending money we don't have, which is not good. And so I think there is a growing sense when you look at the polls that there is a better likelihood now than there was, say, a month ago of a Trump victory. And if there is a Trump victory, connecting the dots, in theory, that's less inflationary, and therefore that's good for utilities and REITs. I know that to some of our viewers and listeners, that may sound like a bit of a reach, but I think that's what the market is trying to do right now. Connect the dots and look forward.
We're trying to connect the dots, make sense of it any way we can, so we appreciate it. Now, you did mention the CHIPS Act. That gets me thinking about chips. It's interesting that we have gone through the lion's share of big tech earnings, and everybody was very curious about how they'd perform and what they'd say about AI. But we are still more than 2 weeks away from the company that gets most of the attention on AI, which is Nvidia. And it is a stock that you continue to like. Everybody always asks the question about the run-up we've seen, whether or not this name is going to lose momentum and just got too hot. How do you think about businesses like this one?
It's a business I want to own, John, and not just because of the AI hype, but because there's so much fundamental strength at Nvidia. We all know, right? Nvidia makes the world's fastest chips, 40 quadrillion calculations per second, way faster than anybody else. That's the backbone of what makes artificial intelligence possible. But the story, John, is that Nvidia continues to grow. So not only is Nvidia innovating and continuously producing faster chips, but we're talking about earnings growth of somewhere between 75 and 90%. That's incredible, John. So you say to yourself, well, yeah, but Nvidia's trading at 30 times earnings. Okay, fair enough. 30 times earnings. Is that expensive? Well, the S&P trades at 20 times earnings and is growing 10%. Or you can buy Nvidia trading at 30 times earnings and growing almost 100%, right? 10 times faster. So yeah, I'm very happy to pay that 30 PE to own a business growing that fast.
AJ, always